Hello and a very warm welcome to you all. I'm Michael Watson, Head of Distribution Asia Pacific with La Trobe Financial. Thank you for joining our November investor call. In this update, I discuss inflation, interest rates, residential property, the supply of credit in the market and the direction of the economy itself, while also providing a monthly summary of the La Trobe Australian Credit Fund. Let's get started. For the first time since 2015, Australia's underlying inflation rate returned to the Reserve Bank's target band of 2 to 3% with a reading of 2.1%. It's our view that many of the underlying drivers of inflation will be short-lived. With the world resetting from the impact of COVID, some friction is inevitable as markets reopen, demand picks up and supply plays catch-up. Elevated energy costs and supply constraints are building inflationary pressures in markets like the US, with a recent inflation print at 6.2% per annum, and the UK, which sees inflation currently of 2.9% per annum. A key driver of US inflation numbers is the increased cost of gasoline and other fuels. The demand for gasoline has returned to pre-pandemic levels, but supply hasn't caught up yet. Likewise, in the UK, the impact of inflated transport costs is contributing 1/3 of the total inflation result. Remove that factor, and inflation would appear much more benign. Here in Australia, the largest contributor to the quarterly change in inflation was the cost of transport, with automotive fuel prices driving the outcome. Unsurprisingly, in the Australian context, this was followed by housing and household furnishing, equipment and services. Investors looking for an increase in RBA cash rates earlier than 2024 may be disappointed. Following a rally in bond yields through late October, the Reserve Bank revised its efforts to suppress the 3-year yield target, which it had previously forecast to maintain until mid-February 2022. In its subsequent November statement, the RBA did push back against expectations of aggressive tightening. This response saw Australian government 3- and 10-year bonds both soften following their respective peaks on 1 November. Our view of lower for longer is still supported among a global yield desert. Internationally, the big four central banks, the Federal Reserve, the European Central Bank, the Bank of Japan and the Bank of England are still all engaged in substantial QE programs. Policymakers are aware that economic activity and employment are still recalibrating following recent rises in COVID-19 cases and other transitory disruptions. Locally, market expectations of a rapid increase in the cash rate do not reconcile with economic settings. The Reserve Bank has reiterated the prerequisites to loosening interest rate settings include sustained full employment, wage growth, and inflation sustainably within its target range. Finally, we do note that the upward movement in bond yields has had an upwards impact on major lenders' fixed-rate home loan offerings. In early November, one notable Big Four bank raised fixed rates by 50 basis points for 4-year, 40 basis points for 3-year, and 25 basis points for 2-year fixed terms. Property price growth continues to be strong. We predict that current levels of month-on-month growth will sustain through Q1 2022 before normalising to single-digit national growth. The overall market dynamic is of low total stock and demand outstripping supply. Residential property prices rose by 1.49% nationally in October, following a rise of 1.51% in September. Auction clearance rates remain universally high in all capital cities. Demand is supported by a range of factors. Even with October's increase in unemployment to 5.2%, this figure remains low by historic standards. An employed population in lockdown has seen savings rates grow, with Australian household deposits now at nearly $1.3 trillion. Combined with ongoing, historically low interest rates, demand-side conditions have been very strong. Supply has recently been boosted by new property listings through the spring selling period, But even against the slowest population growth in a century, low total stock is still the feature of the market. Supply of stock is set to rebound through 2022, with the 64,596 dwellings commenced in the June quarter, the highest quarterly observation in 20 years. While the surge in prices through late 2020 and early 2021 has passed, the market by any indicator remains strong. Any calls that the property market is set to fall dramatically right now appear to be very premature. The Australian economy is bouncing back following the ending of lockdowns in New South Wales and Victoria. High-frequency data shows recent economic activity rebounding, steeled by low unemployment, strong household balance sheets, a surging property market, and unified government and regulatory support. A broad review of leading economists' GDP forecasts for the calendar year 2022 range from 2% to 7.4%, demonstrating unified overall consensus for positive economic growth in the year ahead. Unemployment, a standout feature of the post-COVID economic landscape, peaked at 7.4% in July 2020 before receding to a low of 4.5% in August 2021. October saw an increase in unemployment to 5.2%, with increases of 0.8% and 0.9% in New South Wales and Victoria. Elements of frictional unemployment are inevitable as economies reset, people re-enter the workforce, they change jobs, and international arrivals resume. While there may be some month-on-month variance in observations, this figure will likely return to low bounds through 2022. Household net savings rate, which tracked between 4% and 11% across the last decade, spiked to 26% through the lockdown period in 2020 before normalising to 10%. Subsequent Q3 2021 lockdowns saw savings rates increase back to 15%. Likewise, national aggregate credit card balances fell from $40 billion in 2019 to $27 billion in September 2021. These combined factors demonstrate significant dry powder in Australian household balance sheets to drive consumption and protect against volatility. Our monthly review of credit growth sees residential lending volumes continuing to normalise following a period of strong growth. After the monthly volume of new loan commitments doubled between May 2020 and May 2021, each subsequent monthly observation has seen total new loan commitments decrease. September saw further month-on-month retraction of 1.4%, driven largely by falling demand for owner-occupied credit. Of course, growth in credit over the past 12 months has drawn the attention of regulators. APRA and the Council of Financial Regulators continue to closely monitor residential mortgage lending and have flagged additional macroprudential measures should any risks in the system continue to build. We note that following a period of economic disruption with extended lockdowns, this sector still observes low arrears and low requests for hardship assistance universally. October month-end figures show the La Trobe Australian Credit Fund at $6.821 billion of assets under management across our 7 account offerings. Each of our portfolio accounts again recorded benchmark outperformance, demonstrating their value as a quality source of low volatility income in an environment of low interest rates globally. A very deliberate response from our CIO office in response to the impact of COVID-19 was to take an elevated liquidity position across our portfolio accounts. This acts as a buffer against volatility and is an important step we took as careful stewards of investor capital. We note that a reinvestment bias has begun, and you'll begin to see a very orderly return to full investments in the months ahead. Within our portfolios, asset quality remains high, with borrower pandemic hardship relief retaining low settings at just 0.6% of total portfolio holdings. Borrower arrears at 3.8% across the entire credit fund are also at the low end of historic observations and a sure sign of portfolio health. That concludes our November investor call. We thank you for your ongoing support and remain committed to acting as careful stewards of your capital. Our team remain on station to assist with any queries you may have on 1800 818 818. Thank you.